The BRRRR strategy sounds amazing on podcasts until your contractor disappears, the appraisal comes in low, and the numbers stop working. The biggest lie in real estate is the HGTV dream. Buy a cheap house, fix it up, and repeat. It sounds great until you realize it doesn't scale.
Yeah, I think the first part of that is interesting because, like, for the BRRRR to work, everything needs to go right. I think that's the theme, right? Like, if it goes right, you can do well. But like, where are we in the market cycle? Where are interest rates? Is it realistic in the area that you're purchasing to actually have enough value to go refinance everything out? How much is it going to cost to renovate? And then you talked about like contractors disappear. I mean, again, if things don't go right, easily you could have an overrun on renovation costs. You could go to the bank. It's not worth as much as you thought. Interest rates are a little higher than you thought. Like, everything's kind of got to hit right for it to work. And if it doesn't, then you're holding the bag.
I'll tell you what, my flipper friends have a lot more oh shit moments in real estate than all my buy and hold investor friends, myself included. I mean, we're buy and hold investors. Look, you can be successful. You can make money flipping homes, and even holding the properties. That's the old BRRRR method. We did an entire episode on our better and improved BRRRR method, right? It's buy and reposition, not buy and renovate. We talk about being able to reposition commercial properties by increasing the NOI, by decreasing expenses, increasing revenue. That can be done with rent increases. That can be done with maybe property managers that are being paid, but they're really not working. It can be done with utility bill backs in the commercial space. That can be done with lease negotiations and amendments to leases. There's a lot of things that can be done. But I'll tell you, my flipper friends, my BRRRR buddies, as you want to call them, that worked until it didn't, and a lot of these BRRRR buddies got their asses kicked because they got to the end of that BRRRR where they're supposed to refinance the property, and they cannot refinance that property. I know some people right now sitting on some portfolios where they're going, oh shit, I bought these properties, I started renovating them, and I am not going to be able to rent them out for what they're worth, and I am not going to be able to refinance these and pull that money back out, and I am not going to be able to refinance these and keep these. And I don't want to spend this whole episode just talking shit about flippers, but I'll tell you, repositioning the property through increasing NOI, to me, it's a way lighter lift. You can increase so much more value, like increase the value so much more and make so much more money doing that. I don't know why all these like early, like why people get in this trap of like thinking that single family is the way to start. Even though we all started in single family, I don't think any of us started with like thinking we're going to buy a property, improve it so much that we're going to make money on the takeout and then keep it.
Well, I think too, it's like, I don't think it's a bad place to start. Look, if you're young, you're scrappy, you don't have a whole lot of money, you're trying to figure it out, you find a single family or duplex or whatever, and you can kind of get yourself into the game. Like, I don't think that's a bad way to get in the game if the situation's right.
To flip it or to hold it?
To BRRRR and hold it. To BRRRR and hold it. I preferably. I don't love flipping overall. I've never been a good flipper. I think flipping, it's great until it's not great. I know a lot of flippers right now who are getting burned. And so, because of a market slowdown and interest rates. And so, I guess what I'm saying is, like, I think it's an okay place to start, but like scaling in single family BRRRRs or flips, I think is a disaster. And part of the reason is, like, you got to realize we only have so much time and so much effort we're able to give each day. And when you're flipping and you're running a very high transaction business, you need a lot of attention for project managers and for contractors and all of the things, not to mention it's not tax advantaged. When you step into the larger multifamily properties, you've got the taxes are on your side. I mean, there's a ton of tailwinds, in other words, right? Like, I think about my day or my year, and I might have a couple issues here and there, but like for a flipper, when the music stops, they're in massive trouble. And so, like, it's a totally different game.
Let's get off of talking shit about flippers. Like, we all agree flipping can be all of us, meaning us too. We agree.
I love flippers. I hate the method, the strategy.
Flippers can, they can do their thing, but let's not talk about just flippers. Like, the BRRRR method was buy, renovate, rent, refinance, repeat. So true BRRRR is like you're holding on to that property. You're keeping that property for a rental. Let's kind of go back to that. I mean, there's just so many unpredictable variables. I think a lot of people get into a BRRRR to keep it, and they end up in a position where they have to sell it. Or because it's not a perfect market, the numbers don't make sense anymore because they're required to have a great appraisal. They are required for this property to be more valuable than what they bought it for and the money they put in. So we're talking two things. I think we agree on the flipping side. Let's go back to the original BRRRR method of buy, renovate, rent, refinance, repeat. Like, why is that risky? Why is that a worse plan than repositioning a large commercial property?
Well, for me, it's about time and margin. I mean, personally, if I think about this, like think about this. Okay, you find a single family home, you implement the BRRRR method, and everything goes right, and you have $250 in cash flow. You got your money back out, great. You got a couple $100 in cash flow. If anything goes wrong in that property in any 1 year, all of your cash flow is gone, right? You probably also don't have the margin to have a good manager. Maybe you do, maybe you don't, but it's right on the line. So probably you're talking to the tenants, you're running applications, you're fixing things. And if one thing goes wrong, all of your cash flow is gone because you have one roof, you have one HVAC, and you have one tenant. So for me, it's just too small of a model to make sense across scale. I don't mind it for like, I'm going to go get in the game and figure this out and use it to sort of, break the seal and like get some experience. I think that's fine. But like, that's like saying, I want to be a race car driver. I'm going to drive a go-kart forever.
Hey guys, if you like what you're hearing on the 0 to 100 podcast, come join the 0 to 100 Elite Mastermind. We have a very simple goal for you. That's replace your day job, make $120,000 a year plus in cash flow, real estate, and become a millionaire. That's it. If you like that, if that's you, click the link below and we'll see you on the 0 to 100 Elite Mastermind.
But don't you think it also seems like a riskier place to start? Like if you're buying a property and the end game is that you need that property to be worth more, whether you're selling it for a profit or whether you're trying to refinance out, don't you think that's a lot riskier than buying, say, a 5-unit or a 10-unit or even a 50-unit place? Now, people will say, like, if they hear this, they'll be like, yeah, but it's much harder to buy a larger property, which is not true. It's actually easier to buy a larger property because the value of those larger properties, commercial properties, are based on the NOI, based on the income that property is producing. So doesn't it make more sense to buy a commercial property that's purely mathematical, that makes sense, that you know what the end game is, you know what the valuation is before you close the deal because you factored things in like rent increases, or on some of these triple net commercial properties that I'm buying that I'm focusing on right now, it's lease negotiations, it's rent increases, right? So like it's a math game, and I know what this property is going to be worth, more or less, but I'm not reliant upon having to renovate the property. I'm not reliant on this property needing to be, it will be worth more because I know the NOI will increase because of the rent increases that I've negotiated up front. I'm working on a deal right now. It's a 20-year absolute triple net lease with 2.5% rent bumps every single year. There's no renovations. The tenant's responsible for tax, insurance, maintenance, repairs. It's a 20-year lease. So I know what that property is going to be worth in 5, 10, 20 years. Even if values don't go, even if cap rates don't compress, there's rent increases and there's principal pay down, and I'm not having to renovate this thing. More likely, cap rates will actually compress and will be worth a lot more. I kind of went off on, I often go off.
No, that's fine though. But globally, I see what you're saying. Yes, I do think like fundamentally, if I'm just sort of like 30,000 foot, I think that buying a larger property, 5 units plus, where you can lazy reposition and you can force appreciate that, is less risky than a small single family BRRRR. But I think risk is different for different people. And the reason is, risk to me is like all about what you know and who you know. So for example, like if you're going to go out and either BRRRR a single family home or you're going to buy a 10-plex, but you know nothing about a 10-plex, you know nothing about commercial real estate, you know nothing about forced appreciation, you know nothing about the numbers, and you don't have a network that can support you, then you're going to potentially fall on your face more than the single family home. Potentially, because you could buy the wrong deal and just get absolutely hosed on that 10-plex because the seller knows the game and you don't. So I think risk depends on who you know and what you know. Now, if you're in, and again, I'll plug this, right? Say you're in a mastermind like ours or ours or somebody else's, and you have a network around you. Well, I mean, everybody else's sucks. That's the problem.
Our members are actually taking down large deals. Our members are
they're actually doing it.
The real estate. They're doing it. They're around people that are doing it, not just us, like not just you and myself and Travis, but around other members taking down multi-million-dollar deals. They're partnering. They're raising capital. They're like it's an actual community of people that know how. So it's why our members are not doing a single family BRRRR and why they are closing on 40 unit mobile home parks for their first deal. It's why they're going into these larger deals, because they make financial sense and they've gotten around people that understand. So to your point, I think it's way riskier to do a single family BRRRR on your own than get around the right people. You want to take down
around the right people. Then get around, and that's what you have to do though. You have to get around the right people, because I also was in the single family world for a long time, 13 years technically, before I bought a bigger property, but I couldn't break through because I wasn't around the right people. I didn't know how. And that looked way riskier. Sorry, I stepped on you, but it looked way riskier because I didn't have I didn't know the right things and I didn't know the right people.
But it's also it's not just only getting around the right people. It's you can get around people that have done it, that have actually made the mistakes. I think a lot of investors, they get in, they think they have to fall on their own face. They think they have to get their own bruises, their own bloody noses, their own kick in the crotch, right? I was going to say kick in the balls, but yeah, we have male and female investors in it. Yeah. Well, anyway, taking to something you get my point, but you can compress so many time frames. You can learn by your own mistakes, but you can also learn by other people's mistakes. So when you're in a community, when you're around people, when you have friends, when you have someone you can call and say, hey, I'm looking at this, let's take the single family and the 10 unit example. I would rather buy that 10 unit, find someone that's done that before, that owns these small multifamily, who's been there, than fall on my face on a single family BRRRR or single family flip. I'd rather go partner or get information or learn or whatever from someone who's done it, so I can buy that 10 unit place or more that's value is based on the NOI, take down that property and not fall on my face, because I have people in my network, I have people on my team that are going to help me, and they're not going to let me fail.
Well, I'll say this last thing, we can wrap it up. I wasted a ton of time running solo. Didn't have a network, and I had a small network, I should say, but my small network was doing the same thing I was doing. They were playing the same game. So guess what? I was learning. I was just learning how to play the game I was playing a little bit better through them, but I was fundamentally playing the wrong game. And my game was go to work. I worked, a couple different jobs, military, and then a couple different companies. I'd go to work and I'd pinch my pennies and I'd save up until I had enough money to go buy a little rental property, produce a little bit of cash flow, and then I'd be broke again. My family would be broke, right? Because I got rid of all my money into this investment. I was cash poor, but growing my equity. And that was fine, right? That's what we're taught. The problem though is I was pinching my life. And as my kids were starting to get older and we were growing as a family, wanting to buy at a different house or go on a vacation or whatever, I was always going, well, God, I could either go on a vacation or I could save my money. And that was the way I looked at it. What I didn't realize was I just had to walk through this door. Once I walked through the door and I realized I could buy bigger properties, it was based on raising money and or structuring the deal with seller financing, working with commercial banks, force appreciating, taking advantage of the tax laws, all of these things. Once I walked through this door, changed my entire perspective. No longer did I give a shit about what was in my bank account. It was more about putting together this puzzle. And that changed with what I know and who I know.
Well, that is the true value of a mastermind, true value of a community. And it's not that everyone's going to be partners. I can't tell you how giving and how kind, I think of our 0 to 100 elite members, they just pour into other members. They're not all partnering. Some of them are partnering, but they just pour into each other. And those that are more experienced give the least experienced, just so much information. And I think about, in my life and I don't partner a lot. I don't have a lot of partners, but I have so many people in my life because I've grown a large network with people that when I have a question, I can reach out to and I can find someone and have people in my life that have far more experience than I have in maybe a certain asset class or a certain area, or they've fallen on their face in that particular area and they can help me. I don't have to go through 10 years of pain to find out the same information I can get from a quick text or a call.